Okay, good morning, everyone, and you're all very welcome to the first of our Coffee Microcaps results webinars. We're going to have one this Friday and we're going to have one next Friday. We're just finalizing a few more companies for the one on Friday, the 5th of September. So watch out on your emails for the agenda and the link for that webinar coming through probably around Tuesday, Wednesday next week. If anybody's joining us for the first time, my name is Mark Trajan. I'm the founder of Coffee Microcaps, and you're all very welcome. For all of our regular attendees, I can see a few names popping up here that I'm very familiar with. Welcome back, and I hope everybody's had a decent reporting season. I would like to give a special mention, of course, to RAS Research as a Service, who are our sponsors here at Coffee Microcaps, help to keep these webinars free for all our attendees. If you are looking for some coverage on small and microcap names that maybe aren't covered by some of the sell-side brokers, please do check out their website. They also now have a premium subscription service where you can get even more coverage of some of the small and micro cap names on the ASX. And as always, a very warm welcome to any of our friends from ASIC who might be joining us this morning. For anybody who's joined us for the first time, just a quick recap of the companies we tend to have on here. Market cap under 300 million, our definition of a microcap, in revenue and approaching cash flow break even, or as we'll see with some of our companies this morning, already profitable. We tend not to have companies from the resources and biotech sector on here. The revenue one tends to be a hard hurdle for them to meet. And what I like to call industrial microcaps, which captures everything else from financial services, healthcare, consumer goods, hardcore industrial engineering product companies. We've got 5 companies this morning, so a pretty full deck. We're going to get straight into it now in a couple of minutes. Remember, it's 30 minutes for each company, 20-minute prezzo, and we'll do 10 minutes of Q&A. If you do have any questions, please type them in the Q&A box rather than the chat function. Just makes it easier for me to moderate the questions to our presenters. And the webinar is being recorded and will, as always, be posted on the Coffee Microcaps YouTube channel, and we'll throw that up on Monday morning. You can follow us pretty much on all the socials, LinkedIn, Twitter, YouTube, for all our content. And I do write a free monthly newsletter, which will be going out on the 8th of September. First company up this morning is a returning presenter. We're going to have BNK Banking Corporation. After that, we're going to go down to Melbourne for another returning company. We have Paul Gillespie from Smart Parking joining us. Then we're going to head over for another returning guest, Michael Shirely from Veris, be joining us from WA. We'll still be in WA, but then we'll have Sam Budiselik be joining us from Cash Converters. And then finally, we will be back here to Sydney for Trajan Group Holdings, Stephen Tomisich, who will be joining us for the first time. So we've got a new company lined up here for you this morning. For people who haven't come across the Trajan story, you'll get to hear it firsthand. But I am going to stop sharing my screen and hand you over to Allan Savins, CEO of BNK Banking Corporation. Allan, good morning.
Good morning, Mark. How are you?
I'm very well, thank you. Yeah, if you just want to go to slideshow mode there, please, Allan. Yeah, that looks perfect. You can take it away whenever you're ready.
Thank you, Mark. And good morning, everyone. I am Allan Savins, and I'm the CEO of BNK Banking Corporation. I'm delighted to participate in today's event to showcase the BNK story. BNK operates as a publicly listed authorised deposit-taking institution under regulation from APRA. It also holds an unrestricted banking licence functioning within the Australian financial services sector. And I'm pleased to take you through an overview of the company and our full year FY25 results. They were actually released yesterday, actually. So please feel free to go to the BNK website for a review of the more fulsome investor package. A brief overview of our timeline. For some may have already seen it before, but I'll try and give you some context. Effectively, we've been a bank that's been operating for over 40 years. So to be clear, we're not a fintech. We've been writing loans and taking deposits in that time. A strategic shift in the business model occurred in September 2018 when the bank merged with mortgage aggregator Finsure and non-bank lender Better Choice Home Loans to uplift and enhance its distribution, underwriting and loan servicing capability. That shift saw in 2020 a closure of our 2 branches, and origination became predominantly online through third-party intermediaries. Important to note, the BNK loans are currently sold under the brand of Better Choice, not BNK, and the deposits are currently sold under the brand of Goldfields Money. Our funding diversification was established in 2021 with the establishment of a Bendigo Bank, a prime residential warehouse, and off-balance sheet Goldman Sachs specialist residential warehouse. In February 2022, we saw the sale of the Finsure business for $50 million, which effectively represented 30 times cash earnings and 2.5 times book value. So following the sale of Finsure, we returned $60 million to shareholders. The remaining proceeds used to strengthen the bank's capital base and support our strategic expansion into higher margin SME lending sector in August of 2022. March 23, we saw the acquisition of $150 million of higher margin residential assets from the Goldman Sachs warehouse. As BNK already originates, writes and services those loans, and they're already on our system and making sense to apply them. In March 24, given the strong performance of the first tranche of assets, we acquired a further $80 million of higher margin loans from that same warehouse. In November last year, we successfully completed an inaugural securitisation transaction, placing the Goldman's specialist residential warehouse assets in the capital markets under the program name of Robusta. In February this year, we saw a strategic announcement with the sale of whole loan sale of approximately $220 million of low margin prime mortgages within the Bendigo warehouse sold back to Bendigo Bank. And in June, we received an investment grade credit rating from S&P Global Rating. So in summary, the bank has seen strong positive momentum, particularly since the sale of Finsure 3.5 years ago. Now, for those that are interested, there was an article published in the Veris East Coast online media last week that also attempted to capture our journey to date, and it did offer some insightful observations about the bank. So what does all that mean in terms of our FY24 results? So effectively, the results show an underlying positive improvement, stronger balance sheet resilience as well. Whilst the banking sector did remain under pressure, but it was structurally sound through FY25, there were significant headwinds, margin compression, heightened competition, rising operational costs, increased cyber risks, and the burden of ongoing technology investment. Despite these broader industry challenges, BNK demonstrated strong core resilience, with capital strength and asset quality holding firm. Against the backdrop, we did deliver the underlying NPAT of $3.8 million, an increase from $4.7 million, or 509% on the prior year. So this result reflects our disciplined approach to margin management, portfolio optimisation, and revenue diversification. Statutory NPAT also improved to a positive $1.3 million, up $8 million from FY24, further reinforcing the financial resilience of the business. Some other call-outs. Net interest income rose 13% to $21.9 million compared to the prior period. Total net income increased 50% to $26.1 million compared to FY24, reflecting strong top-line growth driven by revenue diversification and, again, the portfolio optimisation. Underlying expenses grew by 12%, reflecting a balance between strategic investment, inflationary pressures, and disciplined cost management. The result reflects a positive jaws effect, with income growth outpacing expense growth, reflecting the benefits of our strategic focus on sustainable growth and operational discipline. And net interest margin increased 46 basis points to 1.52% over the year. This uplift was driven by a deliberate shift in portfolio composition, reduced exposure to lower margin assets, the flow-through of our maturing fixed-rate loan repricing, growth in higher margin segments, and actively managing our cost of funds. It reflects the effectiveness of our margin management strategy and our focus on disciplined asset selection. So the strategic highlights was the balance sheet, and the results do reflect the deliberate repositioning of the higher margin lending, and it's beginning to sustain profitability, validating the multi-year strategic plan. We achieved strong underlying and statutory performance, reflecting consistent execution across the business. Net interest income has grown, supported by the improved asset mix and disciplined pricing strategies. We're seeing margin expansion, reinforcing the effectiveness of our strategic repositioning and operational focus. The establishment of diversified revenue streams is delivering tangible results, and this includes our ongoing warehouse fee revenue from the Goldman Sachs facility, the robust securitisation of the Goldman Sachs warehouse assets, which, subject to market conditions, is expected to become a recurring feature. The partial sale of the BNK warehouse assets, which unlocked value, it is now generating ongoing servicing income. Together, these transactions reflect a strategic shift towards sustainable, recurring revenue generation, enhancing financial resilience and long-term value creation. Higher margin assets now represent close to 28% of the total portfolio, achieving our original goal of 30%. The capital adequacy ratio increased to 29%, providing flexibility to pursue strategic growth initiatives with no immediate capital requirements. So FY25 laid the groundwork for future scalability, including early stage investment in technology transformation and continued enhancement of regulatory and compliance frameworks. So in terms of the balance sheet movements, in FY25, the loan book reduced to 903 million, down from 1.37 billion in FY24, representing a 34% year-on-year decrease. This included the strategic 220 million sale of lower prime residential loans to BNK Bank, which was consistent with our repositioning strategy. Excluding the sale, the underlying reduction was 18%, broadly in line with the contraction reported in the first half FY25. This reinforces that what we are seeing is a measured and deliberate reshaping of the portfolio to enhance profitability and long-term value. So importantly, despite the smaller portfolio size, this deliberate reshaping has improved the margin profile of the book and supported a continued rise in net interest income, which reached 21.9 million in FY25, up 13% year-on-year, as I mentioned. This result underscores our belief that profitable growth, not just volume, is the key to sustainable success. A few slides now on the portfolio metrics themselves. Pardon me. So the portfolio's payment structure remains largely consistent, with over 80% of the loans continuing on a principal and interest basis. This stability underscores a lower portfolio risk profile as borrowers steadily build equity and profits. Commercial lending momentum has driven the portfolio shift, partly offset by the prime residential runoff, while specialist residential remains stable. High margin assets represent approximately 28% of the portfolio, as I mentioned earlier, secured by either residential or commercial property. While this shift has also been partly influenced by a reduction in the prime loan book, we've taken deliberate steps to expand our exposure to higher return segments. We've seen a positive shift in the mix and settlement over the past year. By 34.9% of the portfolio had a loan-to-value ratio of up to 60%, increasing to 39.1% in FY25. Meanwhile, loans with an LVR between 60 and 80 decreased from 58.6 to 55.4, and those above 80% reduced from 6.5% to 5.5. So these changes reflect the current portfolio dynamics and our ongoing focus on maintaining a strong risk profile through a more balanced and lower risk LVR distribution. So as at June 25, 44% of our loan book was ahead in repayments, consistent with the position at June 24. This stability highlights the strength of our portfolio and the financial resilience of our customers, who continue to manage their repayment obligations effectively. It's a clear indication of credit quality and ongoing portfolio resilience. Our residential portfolio mix has remained largely stable year on year, with only a slight increase in the proportion of investor loans, notwithstanding the aggregate book size has reduced. Owner-occupied lending continues to make up the majority of the book, which supports portfolio resilience and aligns with our broader risk management strategy. Broader look in terms of our residential and commercial portfolio. Fixed rate loans have largely converted to variable for FY25, with no new fixed rate business being originated. In terms of prime business, new business, we focus on originating loans in the 2.5 million range. Opportunity rises exclusively in metro areas. These types of loans offer greater price elasticity, allowing us to optimise returns while maintaining strong credit quality. Our commercial portfolio has seen strong growth, up 79% year on year to 136 million. The average loan size is 540,000. And importantly, all new lending is secured by first-ranking commercial property, ensuring a well-diversified portfolio and low-risk profile. As we continue to lend against commercial loans, we lend against standard commercial properties or assets. Factory units, retail shops, warehouses, properties with broad market appeal and alternate use potential. These loans are structured as 30-year loans rather than short-term SME cash flow facilities. They're mainly to investment-focused borrowers, not owner-occupation. So this structure therefore limits our direct exposure to the operational risks typically associated with SME borrowers. Offset account balances have remained steady at 77 million at 30 June, consistent with the December 24 position and only slightly down from the prior year. This stability reflects the continued strength in customer cash flow management, even in the face of broader economic pressures. In terms of arrears, as at June 25, 90-plus day arrears in the residential loan book stood at 1.1%, an increase of 31 basis points from June 24. This movement was anticipated, driven by a progressively smaller portfolio base. Importantly, while the percentage has risen, the actual number of accounts in arrears remains very small in real terms, i.e. there's 18 accounts in that 90-plus day bracket, and we are well provisioned to manage the risk. On the commercial front, 90-plus day arrears were 0.95% at June 25, up 6 basis points from the prior year. These continue to track within acceptable levels. There's 4 accounts that actually sit in the 90-plus day bucket. So as with residential, the portfolio remains well diversified and conservatively managed, with provisions in place to support ongoing growth in the area. And as at June, we had no mortgagee in possession cases. So why invest in BNK? Despite the fact that our net tangible assets per share sit at $1. So I'll leave you to have a look at where we are trading and our financial performance, I think, in terms of the turnaround and the momentum generated by the bank with our deliberate transitioning to higher margin assets is definitely bearing fruit. We have a very strong management team within BNK. For myself, I have over 40 years services in the industry. I was 17 years in a major regional bank, commencing my career in 1984. 19 years then in the non-bank sector. I was formerly the Chief Operating Officer of non-bank lender Resimac. I was the chairman of the Finshaw business from launch in 2010 to December 15, which won awards for Australia's fastest growing mortgage aggregator at the time. I was a former director of the New Zealand business of Resimac Financial Services as well. So I've been with BNK now for 7 years. I've been the CEO for the last 3 years. So I've led the pivot into the higher margin strategy for the organisation. As you can see, we have extensive experience. Our CFO, CRO and COO all have more than 25 years experience within the banking sector. In terms of our products, we do have a diverse range, just to focus on the middleware there. We have a wider shop front of lending products than most ADIs, whether it be prime residential or commercial loans, again, all secured by first-class security. Plus, you had a benefit of the Goldman Sachs off-balance sheet warehouse for specialist residential loans. This enables our broker partners to offer a greater array of products or solutions, as we prefer to call it, all with the same lender. So it attracts new customers and retains their existing customer base. And our focus on the SME market has been made possible due to our existing broker network, which now stands at over 12,000 accredited mortgage brokers throughout Australia. So in summary, FY26 for us is about execution and discipline. We're focused on delivering sustainable underlying profitability through a margin-led strategy that balances either quality earnings with long-term resilience. We acknowledge, however, that performance may not always follow a linear trajectory, particularly given the continued competitive environment. While we are confident in our direction, we anticipate variability in outcomes from time to time as we navigate evolving market dynamics. Our growth will come from where we create the most value, higher margin and higher return segments, supported by the scaling of our senior secured warehouse funding that we are now starting to provide to non-bank lenders. We settled our first transaction in July, which is an integral part of our moving forward strategy. At the same time, we'll maintain prime lending in a measured way, providing diversification without compromising our margin strategy. We'll continue to improve our capital efficiency by reallocating into higher return opportunities while maintaining tight cost discipline in a challenging environment. Alongside this, we'll expand our off-balance sheet warehouse with Goldman Sachs, deepening diversification and strengthening recurring income streams. Partnerships and product expansion will remain a strategic priority, broadening our reach through white label and other distribution relationships. As we continue to invest in technology, it'll be done at our capacity and our priorities, modernising our platform to drive future efficiency and strengthen financial or regulatory compliance and resilience. So FY25 gave us momentum. FY26 is about building on that momentum with precision and intent, growing profitably, managing risk with discipline, and creating long-term shareholder value. And there are finally just some slides here just on the board. We do have a very experienced board that's driving the next phase of our growth, which is led by John Denneman, who's special counsel at Dentons and was the first honorary member of the Mortgage and Finance Association. Some other call-outs, we've got David Gratian, who's a First Mac director, and Warren McClelland, who's a non-executive deputy chairman at Resimac associated with Summers Limited. And both of those two entities remain our two largest shareholders. We've also got Calvin NG and Elizabeth Aris. Calvin is a chairman of our Risk and Compliance Committee, and Elizabeth is the chairman of our REM Committee and Audit Committee. So finally, I thank you for the opportunity to showcase BNK today, and I'll happily take any questions. Thank you.
Thanks, Allan. Yeah, we've had a few questions come in there just while you were running through the deck. I might just take the first one. Just a question on, can you explain the difference between the statutory NPAT of 1.3 million versus the underlying NPAT of 3.8 million?
Yeah, happy to do so. We try and record everything above the line. We're not definitely clever in the way that we report. So we want to be very transparent and always have been. So we have a legacy book within the Better Choice business. It's a mortgage management portfolio of loans that's in rundown. So the NPV of that particular portfolio is just a loss every year as it unwinds. And then there's $1 million of that in the below the line, which affects our technology investment, which we made through the year. So apart from that, everything else sits above the line in the underlying result. I feel that the Better Choice legacy book unwind, it is just really a statutory number. It doesn't impact cash flow in any way for us. So that's why we treat it below the line. So hopefully that's clear.
Okay. I've got two questions here around NIM. I might just join them together because one kind of leads into the other. So second half NIM was 1.7%, up 31 bips. And then
Yes.
They're just talking about outlook for NIM, given we've seen, a few RBA rate cuts, and as we know, that takes a while to cycle through books and stuff. So maybe, yeah, just where the uplift came in the second half, I'm presuming it's from the repositioning as you talked about, and then kind of the outlook on NIM now with the easing cycle that kind of kicked off in February this year.
Yeah, that's a good question. So yes, the uplift from June, for the month of June, it just continued with that transitioning, as we said, about the high margins starting to play its way through. We've deliberately changed our composition of our liability base over the course of 12 months. We were a 70% term deposit, 30% at call business. We've now flipped that to the other way around. So in other words, we're 30% to TDs and 70% at call. We did that deliberately because we knew there'd be an easing of the cycle, so we were able to pass on the reductions faster rather than being caught with the higher cost of funding from TDs. So we've already positioned ourselves the best we possibly can to balance stability, liquidity, in the way we manage our liabilities. So that has definitely helped underpin the NIM performance. And we set ourselves a target 3 years ago when the NIM was, I think it was 0.92%, that we would grow the NIM to greater than 2%. So that has always been our medium target. And we believe that with the strategies of higher margin business, moving into senior secured warehousing of supporting other non-bank lenders, we've taken a senior position in a warehouse where we funded a small or a large originator, but a small stake. We think these are all value accretive to NIM. So we don't give guidance, of course, but we did set that medium-term target at 2%. And I think what we've achieved in a little while is sort of demonstration of that. And I don't see that changing.
Okay, and then just another one, just looking kind of from the outside in the industry, private credit, private debt, seems like a very, very hot asset class at the minute. But maybe just give us a feel for, what I know you're not a non-bank lender because you are an ADI deposit taking institution, but just a competitive landscape more broadly with, so much money trying to find its way into these private debt deals, private credit deals, and obviously, competition for mortgages, I think is going to be heating up a lot come the 1st of October, given the changes we've saw now in the last week or two. So, maybe just competitive landscape as you see it, in the various growth levers that you can pull within the business.
Absolutely. So that's the great part about being an ADI. You are a product manufacturer. So the whole model of Better Choice, which was a white labeled business at the time that was white labeling other lenders' policies and procedures, you lost that control. So we actually do see the opportunity when we see fit to deliver products, and the commercial product suite's a great example of that. When we pivoted away from residential and moved into commercial, when we see opportunities that give us the return on capital that we're looking for. It's interesting when you talk about private lending. That's definitely, a hot topic in probably the last 12 months in terms of what people are doing. I don't see private lending necessarily as an appropriate asset class for BNK, but this is where the senior secured warehousing comes in, where we can actually fund other originators, non-bank lenders that effectively have that expertise to do that. So I think we can effectively pick asset classes that make sense and are accretive to our bottom line to write on our balance sheet, and asset classes that may not naturally sit within, let's say, an ADI profile. We effectively then look to secure it by supporting another non-bank lender in a capital structure like warehousing, and we take the senior position that's well subordinated for protection. And I think that's where we'll get the best of both worlds. We can't be expected to be the best, to be everything to everybody. We'll just pick the segments that we wish to play in from a non-balance sheet growth perspective ourselves organically, and then we'll outsource. And it's a cheaper form of distribution as well, where we can let someone else do the heavy lifting and the origination and the management of those loans, and our position takes more of a surveillance and monitoring position as the funder. So I think that's where we can play. And whilst we can't compete head to head per se with private lending as an example, but we can look to compete by looking to fund others, however.
And then if we just look on the other side of the book, maybe just competitive environment for deposits. I know you talked about, flipping the asset side of the
The
book between
compensation,
TDs and
yes.
TDs, and I called it that flip. But just generally, obviously that's one of the cheapest forms of finance that you can get. But how hard do you have to compete on, even the at call rates that you got to put in there for, flows to come in there? Because I saw in the deposit book, it's kind of flattish if we look at it on a 3-year basis.
Yeah, well, deposits is a byproduct of assets. So we don't need the deposits if we repositioning our book. And again, I'd rather do $100 million of profitable loans than $1 billion that is not. And effectively, that's the mantra. So we can raise deposits based on our appetite. To answer the question of how easy it is, I mean, yeah, there's no question that the market remains competitive. We have distribution channels that can bring us the appropriate flows that we need. We manage liquidity on a daily basis. So we set our rates on a daily basis. If we need liquidity, we set them appropriately, and we have no problem with origination flows, particularly through, broker channels like AMM, so Australian Money Market, for example. So inflows, no problem. The greater lead time you can give in terms of needing liquidity reduces down the need to price for it, if that makes sense.
Yeah.
So raising it's not an issue, but it's a byproduct of basically of asset growth, Mark.
Okay. Perfect. Alan, we leave it there because we've finished bang on time. Thank you very much for coming back and joining us. And for anybody who is coming to our Sydney conference on the 16th of September, Alan will be joining us in person for a change at that event. So you can pepper him with more questions at the event in Sydney in 2 weeks' time. Alan, we leave it there. Have a good weekend. And I see our next presenter is waiting patiently in the wings there. We're joined also. We've got Paul Gillespie, CEO of Smart Parking, and I see Richard Ludbrook, CFO, is also joining us. So you're getting
All right.
double.
Thanks, everybody.
Thanks, Allan. You're getting double commitment here from Smart Parking this morning. But I think I'll kick off with Paul to lead off the batting of this dynamic duo here.
Thanks, Mark. I'll just bring up the deck for people to see. Just bear with me.
Yeah. I can see the cover slide now, Paul. Yeah, if you just want to go to. Yeah, there you go. Perfect.
See that? Let's move this out of the way. Got some more. Sorry, give me 2 seconds. There we go. Excellent. All right. Thanks, Mark. And good to see you guys again. You can hear me all right? So just testing the microphone.
Yeah, your volume is good, Paul.
Okay, great. Well, look, thanks very much. I'll obviously take you through the deck that we presented last week when we announced our results last Wednesday. And I've got a bit of a script here to run through. So obviously I can take you through this, and Richard can take you through some of the financials as well as we move through. But if we start on slide 2, which is where we are right now, I guess it's the first thing to highlight is we're incredibly pleased to announce another set of record results. We've delivered 47% growth in adjusted EBITDA and a 37% rise in EPS. We generated $9.5 million of adjusted EBITDA in the first half of the year and $11 million in the second half. I will call out that the second half does include 4 months ownership of Peak Parking, which was the acquisition we made in February of this year. We had a strong finish to the year, which boosted our results and sets us up well as we go into FY26. But if we compare to the PCP for 25, revenue's up 42% to $77.2 million. For the first time, we issued over 1 million PBNs, which is a milestone for us, is up 21%. Adjusted EBITDA is up to $20.5 million, and adjusted margins have expanded 110 basis points to 26.6%. We generated $13.3 million of free cash flow, and we're clearly growing strongly, expanding our margins and delivering cash flow and earnings. Also, we raised $45 million in February to fund the Peak Parking acquisitions, which of course, and we closed the year with cash on hand of $12.7 million. This means we're well placed to fund our technology investments and execute on our growth strategy. If we go to slide number 3 now, if we look back on the year, what pleased me most about our performance was a disciplined execution of our plan. We invested for growth and delivered higher earnings. We closed the year with 1,799 ANPR sites, which is growth of 26%. If we include the non-ANPR sites in the US, our total estate at June 30 was 1,938 sites. We've grown the estate by a CAGR of 31% since 2018 and accelerated this growth to 36% this year. The growth in the estate provides momentum into the new financial year, long-term revenue streams over the life of the contracts, and higher incremental margins as we scale. I'll remind you that our financial model is simple. More sites under management will create increased PBNs and in turn generate higher revenues. We issued over 1 million PBNs in total, with strong growth over the PCP in every quarter. The quarterly average number of PBNs now is over 200, or at 260,000, which is up 21% on the PCP. In 2019, the UK generated 100% of the group's PBNs. As we've expanded into new territories, the UK now generates 73% of the total. SPZ is clearly now a stronger and more diversified company. In FY25, we delivered good growth in our existing markets with 437 new site additions in the UK, New Zealand, Denmark, and Germany. That's an increase of 45% on the PCP. We also continue to invest in our technology. Our priorities are to improve the customer experience and drive efficiencies. We are a technology company at heart. We're enhancing recognition capabilities and reducing the cost of our hardware. With our proprietary ANPR and smart cloud technologies, we believe we have the best parking management offer in the market. We also increase our liquidity. We secured a new 3-year debt facility in November to fund our growth and selective acquisitions. It includes a $10 million US line of credit and an AUD $10 million accordion facility. With our positive cash flow and strong balance sheet, we're well placed to fund our growth. So overall, we can continue to grow across all of our markets. We're focused on leveraging our technologies into new and existing opportunities, and we're well placed to self-fund our growth, which is clearly a strong position to be in. On slide 4, we talk about our successful expansion into the US with our Peak Parking acquisition this year. Peak is performing well, and we're very pleased with the acquisition. Revenue for the last 4 months of FY25 is up 16% versus the PCP, and EBITDA is up 19%. The business is on track to achieve the stretch earn-out target of $4.5 million US by the end of this calendar year. Peak is exceeding the acquisition investment case. The 25% earnings accretion on a pro forma basis that we expected back in February is being delivered. I'll remind you, Peak is an ideal beachhead for us in the world's largest parking management market. It provides a comprehensive portfolio of parking services to businesses and clients across 139 locations, predominantly in Texas, Georgia, and Washington State. Since completion in February, we've been busy integrating the business, deploying our ANPR technology to upgrade sites, and expanding the places where we operate, such as Indiana. The ANPR rollout is progressing, and the smart cloud implementation is complete. Added to this, we've recently opened 7 new locations in Indianapolis and continue to look at new states for expansion. Slide 5 is a new slide, and we show you the group's high-level results for July, 1 month of FY26 compared to the PCP. As you can see, we've started FY26 well with ongoing strong growth. Revenues in July are up 73% versus PCP, and adjusted EBITDA is 60% higher. The purpose of showing you these results for just 1 month is not for you to annualize the performance and set new higher full-year estimates. Remember, our performance is seasonal, with the Northern Hemisphere summer being one of the strongest periods. But we do want to demonstrate the earnings power of the expanded estate and momentum from Q4 of FY25. There's still 11 months to go before we close the year and much to do, but the larger estate does have higher earnings power and good momentum, which you can see on this slide. It's clearly a pleasing start to FY26. Looking now at page 6, we recap on our growth strategy and how we're building scale and leveraging core technologies and capabilities across across new and existing markets. All of our operating territories deliver growth in sites, PBNs, revenues, and earnings. The UK continues to grow strongly, and the contribution from new territories was impressive. Revenue in the UK was up 19% to $52.5 million, driven by new site additions and a broad base of new business wins. Our largest territory continues to grow at strong double-digit rates. We issued 13% more PBNs, which is consistent with the year before, and closed the year with 1,335 sites under management. That's an increase of 19% on the PCP. EBITDA increased by 17% to $16.7 million. These are solid results. Our UK business has a long growth runway. We estimate the TAM is around 45,000 sites, with our market share at less than 3%. We have plenty of scope for growth in our largest business, as well as in the new territories. There's also good development on the regulatory front in the UK. In July, the government released a new industry consultation paper. It's a positive step in the process of setting higher industry compliance standards, which we've been advocating for a long time. Without preempting the result, the paper is significantly more positive and favourable towards SPZ and the private parking marketplace. We will continue to actively participate in shaping the settings and standards for our industry as we move forward. As I mentioned, growth in new territories, excluding the UK, was impressive. In these new territories, we increased sites under management by 72%. We issued over 156,000 PBNs, a rise of 57%, and we generated 70% more revenue. These results validate the strategy that we can drive growth in the UK and scale in new markets. So what's driving this growth in the new territories? Our New Zealand business is a highlight. It continues to perform strongly. We're building scale and driving operating leverage. Revenue was $7.4 million for the year, up 62%. Adjusted EBITDA increased by 128% to $3.2 million, and margins here are the highest in the group at just under 43%. We now have 238 sites under management in New Zealand. That's up 47% on the PCP, and we delivered 48% growth in PBNs. The business has more than doubled in 2 years. Once again, there's substantial scope for long-term growth. With a TAM of 3,000 sites, we have less than 1% of the addressable market and scope for long, enduring growth into the future. In Germany, growth is accelerating. Revenues for the year increased by 60% to over $4 million. PBNs are up 37%, and the number of sites under management is now over 100 at 107 at balance date. It's a good milestone. While we continue to invest, scale is building and will deliver higher profitability. Adjusted EBITDA was a negative $1.55 million in the year. However, we expect our German business to turn profitable this calendar year and for margins to trend upwards towards group levels over time. In February 24, we started operations in Denmark. The business has performed well and generated revenues of $1.3 million in the period. We have the sales team and structure in place. We have 48 sites under management at balance date and a strong pipeline in place to convert. In Denmark, there's been some change in the regulations around PBN issuance since we last spoke to the market. After some discussion with the Transport Department, they have decided the first notice to keeper, or the PBN, in the enforcement process should be placed on the car windscreen. Whilst this will add some cost in our early stages, SPZ is well positioned to respond with proprietary technology to the updates and adjust our process as required. Added to this, we still have access to the driver details database to facilitate the debt recovery process. This is an important point as it drives payment ratio and also provides us with the optimism that the process of the initial PBN issuance will revert back in the near future. This update does not change our growth strategy or ambition in the region, as the commercial environment is still very positive. Last month, or in July, we established a new business in Switzerland. We see Switzerland as a constructive market and a natural extension of our growing European operations. We've recruited a well-qualified managing director to lead the business on the ground and are busy setting up our operational structures to support scale. These are the foundations we've built from every market we operate in. We've started to recruit sales and operational people so we can win customers and commence revenue generation. We expect to invest around $1.5 million in this market in FY26 and start to generate positive EBITDA contribution during FY27. So in conclusion, Why are we winning? Why are we winning in these markets? Well, we provide market-leading solutions and the industry's best practice compliance standards to drive improved outcomes for parking site owners and landlords. We deliver increased compliance, revenue growth, and an improved customer experience for our clients. That's why we're growing so strongly in these nascent markets. I can now hand over to Richard for a few slides where he will talk you through the financials. Richard, do you want to take this one here?
Thanks, Paul. I'll start with slide 12. You will see the statutory basic earnings per share, 1.45 cents per share, is up 37% on the prior year. If you exclude the amortization of customer relationships from acquisitions, the EPS is actually up 60%. Adjusted EBITDA of 20.5 million rose 47% compared to FY24. That was driven by significant organic growth and through disciplined M&A. Revenue of 77.2 million is up 42% on the prior year, and this was a result of a 21% increase in parking breach notices issued, driven by organic growth in sites under management. The revenue includes a 10.2 million contribution for a 4-month period related to the acquisition of Peak Parking. Overheads are up 24% compared to the prior year, and this is a result of increased activity, ongoing investment in the newer territories, and the acquisition of Peak Parking. The adjusted EBITDA margin increased 110 basis points to 26.6%, and this is really pleasing given that Germany and Denmark are currently margin dilutive. The net profit after tax increased 46%, and by 72% if you exclude the amortization of customer relationships. We remain optimistic about the outlook for FY26, given we will get the full year benefit of new sites added in FY25. We'll get revenue from new sites to be added in FY26, and we'll obviously get a full year of earnings from Peak Parking. If you move on to the next slide, please. Revenue from organic growth in the managed services business was 13.8 million, making up 25% of the revenue increase from FY24. And total parking breach notices issued for the first time exceeded 1 million in a 12-month period. The company added 437 new sites, and that's up 45% on FY24, taking total ANPR sites to 1,799, up 26% on the prior year. And we saw an acceleration in the rate of site wins across all territories. Average revenue per PBN issued for the group increased 2% over the year. In the UK, there was a reduction in the average revenue per PBN following the adoption of the industry code in October 2024. However, this was fully offset by enhancements in debt recovery processes during H2 FY25. Peak Parking contributed revenue of 10.2 million for the 4-month period, and this was up 16% on the pre-acquisition prior comparative period. Revenue in New Zealand of 7.3 million increased 62% compared to the prior period. The New Zealand business is experiencing strong inbound inquiry as a consequence of achieving scale in the New Zealand market, and has achieved multi-site wins for iconic global and New Zealand brands. Germany contributed revenue of 4 million, up 43%, and the company is seeing an acceleration in the growth in new sites. In late FY25, the business won a multi-site contract with 25 new Burger King sites. Revenue in Denmark was 1.3 million, up from 0.1 million in FY24, and Denmark ended the year with 48 ANPR sites. Slide 14 shows the group has cash on hand of 12.7 million. The company generated adjusted free cash flow of 13.3 million, up 15% on FY24. The company made a substantial investment in future growth with $8.8 million spent on CapEx and intangible assets. And just a reminder that CapEx isn't included in free cash flow, as it relates to future growth rather than maintenance CapEx. The acquisition of Peak Parking was funded by a successful equity raising for $45 million through a fully underwritten placement and entitlement offer at 88 cents per share. The proceeds were used to fund the acquisition, related costs, and working capital. The company's strong cash flow, cash reserves, and debt facilities enable it to continue to explore new growth opportunities. Slide 15 shows the movement in the group's operating expenses. Overheads of $29.6 million include $1.6 million for 4 months related to Peak Parking. The Denmark operation, which commenced in February 2024 and incurred full year costs of $2.7 million in FY25. UK cost increases included a 9.7% increase in the minimum wage in April 2024 and a 6.7% increase in the minimum wage in April 2025. Including the acquisition of Peak Parking, the group's headcount stands at 310. And obviously FY26 will include additional costs related to the expansion into Switzerland. Slide 16 shows the group maintains a strong balance sheet and is well placed to fund organic growth, expansion into new territories, and further acquisitions. During FY25, the group established debt facilities with a $10 million revolving credit facility and a further $10 million Australian dollar accordion facility available on request and satisfaction of certain conditions. The facility was fully paid down during July. So I'll now hand back to Paul.
Thank you, Richard. I'll just take you through the last couple of slides, Mark, and then we can have some questions. So I guess many people will have seen this page before, but the consistency of our growth strategy is key to good execution. Our strategy is consistent. We aim to drive strong organic growth in existing territories, build scale in new countries, and complete and complement this with selective acquisitions at accretive prices. We have multiple growth drivers. I said earlier, our markets are nascent. We feel that we're at the forefront of driving industry change, raising standards, and delivering better solutions for site owners. Our opportunity is to scale quickly and entrench ourselves as the leading technology provider of parking management solutions across major markets. We can scale through 3 growth vectors. We can build share in our existing territories by displacing legacy providers with archaic systems. We're demonstrating that capability in the UK, New Zealand, and Germany. We can leverage our expertise into new territories such as Switzerland. We look for constructive regulatory environments, legacy-style competitors, and an ability to deploy our technology advantage. We can then take these capabilities and expertise into new markets and build scale. Our proprietary technologies are highly scalable, and we have proven our ability to buy and integrate well to augment our organic growth. Our model is capital light, cash flow positive, with high return on investment. And we will continue to supplement this growth with accretive acquisitions. It's a question of capital deployment, speed to market, and risk-adjusted returns. Peak is a great example. We have a good balance sheet and will continue to ensure expansion is at low cost and risk-averse. On page 18, I'd like to highlight some of our execution strengths. It's the key to how we scale and transport the business model. This new page lays out the key pillars of our process from site origination and conversion through to technology implementation and the regulatory expertise. You can see the depth of the domain expertise we have developed over a decade across these pillars. These strengths are a competitive advantage. They create moats around our business and enable us to scale. I'll close now on slide 19 with an outlook and priorities, then open up some questions. In FY26, we have a positive outlook and expect another year of profitable growth. We have good momentum, as you've seen, and we've started the new financial year very well. So what are the key growth drivers? There are several that should deliver irrespective of any wider macro volatility. First, we have a full year contribution from the 437 new organic sites we added to the estate last year. That's captive growth. We'll get a full year's contribution from Peak Parking, which is growing strongly. That's an additional 8 months of earnings this year. We see further margin expansion from technology implementation in the North American market. The opportunity to upgrade site performance with our proprietary ANPR technology is a key part of the opportunity here. We will continue to add new sites. The pipeline's strong. Sales execution will deliver a significant uplift in sites under management across all our major markets. And we'll continue to selectively add further acquisitions to accelerate our growth and enhance our earnings. Acquisitions provide opportunities to leverage our market-leading proprietary technologies and offer customers a differentiated and superior service. That now completes our presentation, Mark. I'm not sure if you've got any questions from the floor.
We do have from the floor, Paul, and the first one is regarding the US potential in growing ANPR-enabled parking management. Why hasn't this been, a model rolled out by, other substantial players in the US market, given, it's not a new technology? So maybe just a comment on why there is an opportunity to implement ANPR versus the incumbent players in the US market.
Yeah, sure. I mean, I guess first things first, the technology's not adopted that quickly in the US. We've seen that across our market over many years, like pay-by-phone parking, those sorts of things. They're coming to the fore now, but they're a bit slower to adopt the technology. So that's the first reason. Second thing is, it's not just about the ANPR technology, right? So ANPR, you're right, is not new. What we have that's different is that whole back office platform, Smart Cloud platform, which is an enforcement product. It provides permitting solutions, provides pay-by-phone solutions, provides a customer portal where the landowner can actually get a web interface with Smart Cloud to understand what's going on their site at any one time. So it's a full end-to-end solution that's proprietary to us, that's quite unique, or is unique in the US industry. And whilst there's one or two other players, we've got similar products with similar number plate recognition and enforcement solutions. Not many people have got the whole end-to-end process like we have. And I think that's really what differentiates us, Mark, and that's what takes us, or excites us with the opportunity in front of us. But don't forget, we want to run a dual strategy in the US. We want to maintain the existing market they have. We want to keep growing in that place, those traditional services that Peak provide, which are very strong and unique in the market. We're then going to add the resource, the technology, the people and the deep domain expertise to really open up a much wider market segment that no one's really servicing in the US. And that's the really exciting bit, is the number of potential sites and opportunities that we identify on a daily basis with our tech.
Just sticking on the Peak one, 5 months in, initial experiences and kind of the insight you've gained on what that might mean for how you grow organically in the US or inorganically. Now that you're kind of in there, it's being integrated, has that shaped how you might adjust the strategy on either organic or inorganic expansion in the US?
Really, I mean, if anything, it's reinforced that we've made the right decision. We've got a great team of people. The organic opportunity is enormous to have a go at, and we believe, and we can see already with our technology, that we're well placed, we're unique, we're different in the market to actually make a real difference with some of these customers, and that's already being proved, or being proven, I should say. But the inorganic opportunities are also there. I mean, there's clearly, when you go into any new market, and particularly via some sort of inorganic means like we have done, it creates a bit of noise, it creates a bit of activity, and we've had opportunities presented to us that are interesting and exciting. But what I would say is we've been incredibly disciplined on our M&A strategy, and we're going to continue that. We have to keep asking ourselves the questions of, can we make this particular asset better with our know-how, our experience, our technology, our experience, and can it make us better? Can it give us more opportunity? If we can answer yes to those questions, then we should go further and take a closer look. If it's no to any one of those questions, then we pass. And we're going to maintain that discipline. Whilst there's lots of opportunity there, we're interested and excited by what's in front of us. We've got to maintain that discipline. because there's also a big organic opportunity. You don't have to go too crazy too soon in organic, because you can basically work with what's on your doorstep, so to speak, straight away.
Exactly. I mean, you're in, I think, probably 4 out of the top 10 most populous states. I mean, one parking site in Florida, I think the population of Florida is like nearly the same as Australia. So there's definitely organic opportunities there. One last question, a quick one, if I can, just for Richard and Paul. You slightly touched on it in terms of seasonality. Obviously, peak coming in for a full year, Germany still growing, very strongly, Switzerland, Denmark coming. The impact on seasonality, Richard, have you kind of modeled out what it's going to do, in terms of split of revenue and profits, 60-40, 50, as things, get more Northern Hemisphere centric, especially over the course of this year?
Yeah. So I guess US is a little bit different. So certainly January and February are pretty quiet, but we were there in March in Austin, and there's big festivals on like South by Southwest, and March, April were just hectic. I mean, July's a little bit quieter. It's really hot and people are on holiday, and then it starts to get really busy again. So you'll still see quite strong seasonality, which there's a graph of the parking breach notices, which I guess models the seasonality quite well.
Okay. We'll watch out for
it.
Paul, Richard, unfortunately, we've run out of time. We'll have to leave it there. Thank you once again for coming back and joining us. And we will now leave Melbourne, or I'm assuming that's where Paul and Richard are, and we'll head over to WA. We have Michael Shirely, CEO of Veris, and Steve Harding, CFO of Veris, joining us. Good morning, gentlemen.
Hi, Mark. How are you?
Very well, Michael. If you want to bring up your slides, Michael, I'll let you know when I can see them. Steve, good morning.
Morning, Mark.
Yeah, I can see the cover slide now, Michael. You can take it away whenever you're ready.
Great. Thanks very much, Mark. And thanks everyone for joining us this morning. And, I am joining you from Melbourne, Mark, and Steve's joining us from Perth, nice and early. So to get underway, look, 2025 has been an exciting year in our transformation journey in Veris. The original strategic premise behind Veris was to become a national surveying business. And since we and the new leadership team have embarked on this transformation of Veris, it's been a really fragmented industry, and we decided that model alone would not succeed. We developed our strategy to be a differentiated spatial data business, and we're positioned to leverage our spatial data capability to provide really high-value solutions. The application of digital twins, spatial data, AI are a unique proposition that we bring to the market from the base of our surveying and spatial expertise. And Veris are really targeting that growing need for value from digital innovation in the infrastructure sector. And we think we're starting to make really strong progress in going forward. So today, I'm not going to go through all of our capabilities in detail. We've touched on that many times. And suffice to say, our national position and our depth of capability position us really strongly at the top end of the market. Our alliance with Woomera is a really authentic opportunity to build our Indigenous capability and our market position across where we operate nationally. We've got a really significant market in front of us at the moment with our strategic positioning. The addressable market is more than $1 billion, and we approach that with a strong differentiated proposition. We have a unique capability with spatial data to provide actionable insights that create value for our clients. And our capabilities now allow us to advise clients on their digital transformation and support them to embrace emerging technologies. Our professional services strategy means we're focusing on quality key clients with a high value proposition and repeatable workload. And we're working hard to build strong relationships and trust with those clients. Our approach is based on value, not the cheapest price, and we're continuing to deliver margin and not just chasing volume. Our investment in the last few years has been to develop technology capability, including AI and some of our platform development, that really allows us to solve problems and create value with these strong clients we've got. In the early years, our strategy was to save the business, and from there we wanted to build a strong and sustainable base for growth. And now we've moved from rebuilding the business to stabilizing the business, and we've got that stable base with organic growth, and we're now in the position to accelerate the transformation of Veris. And this has leveraged our digital differentiation using our digital solutions and our approaches to provide actionable insights. Our strategy is anchored still in that spatial data capabilities, and we're really focused on building value, not low margin revenue. We've expanded from that low margin, high volume work to a high margin, value-based model, and we're now broadening our revenue growth through some different streams out of our digital solutions that have come to market over the last year or so. This year's of FY25 has been really a year of significant progress, and I just wanted to touch on some of the highlights. We've continued strong organic revenue growth, over $97 million of revenue this year, and importantly, that's delivered a $2 million profit, which has allowed us to pay a dividend to our shareholders. This dividend is a 55% payout ratio and a significant return for shareholders. And demonstrating the strategy, execution, and focus on profit, we've continued to improve our gross profit margin up from 32% last year to over 36% this year. We've been cash generating for the year with our net cash growing, even though we've used some cash on our spatial vision acquisition and our share buyback. And our digital and spatial revenue has grown to more than 25%, which is up from 17% last year. This growth really shows the progress of our transformation, and the overall outlook is really strong. We've got a committed workload of over $65 million, and in the last 3 years, we've delivered over $3.2 million in returns to shareholders in capital management initiatives, and we've done this while transforming the business in a really unstable economy. There have been some really key outcomes for us that we want to touch on in our for this year. First of all, is our spatial vision acquisition has been a great demonstration. It's the first of our acquisitions since the rebuilding of the business, and it's shown our ability to accelerate our digital advisory capability. It's positioned us into some new areas in the market and delivered strength early on in the integration, which has been great to see. Our digital strategy is really gaining some momentum, and we've had a strong uptake of some of our products like Roadside, Digital Urbanism, and Vantage. And now we've got new solutions like Bridgeside coming to market, which we think will commercialise significantly over the upcoming period. We've expanded our consulting and advisory capabilities across the life cycle of a range of big projects, and we've been able to build our environmental skills, our digital advisory skill sets, and that's really positioning the business as a strategic partner, adding high quality, high value advice to our clients. We've continued to really shift the business away from this small projects, transactional outlook in world, and we've really focused on building larger projects, more complex projects with our key clients. And you see that this year with a 50% uplift in the average value of our new projects. So we're winning bigger, more complex, multidisciplinary projects, and we're seeing that translate through in the numbers this year. We understand that Veris really is fundamentally a people-based business. Our people are core to our innovation and the solutions we develop and deliver with our clients. And we've really transformed our employee experience over the year, investing in strong talent, investing in our internal development programs, and you see that through things like our award-winning graduate development program and the work that's doing in developing talent, bringing it into the business. About 14 months ago, we went through a big operational restructure in the business, really getting efficiency and simplicity in our operating model and letting us focus in the areas of growth in the market and areas we can pivot towards. We've seen that really help us in efficiency this year, and you see that benefit coming through and allowed us to really accelerate the growth and transformation of the business. So now I'll hand over to Steve, and Steve will give some update on some more of the financial details.
Thanks, Michael. As we outlined earlier, the execution of our Digital advisory and consulting strategy is resulting in our operating model increasingly evolving to focus on client engagements where we have a point of difference in our data capture, storage, analytics, and insights. If we look at our P&L summary, the important point to take away from this slide is that whilst our revenue increased a solid 5% from the prior year, more importantly was the continued improvement in the quality of our revenue, which has continued to increase year on year. This has led to continuing improvements in our project gross profit margins. When the current management team took control of Veris in FY20, these project margins across the business were at an average of 24%. Our focus on project management disciplines has seen these increase successively year on year to now being in excess of 36.5% in FY25. This has been in large part an outcome of our deliberate strategy of targeting these larger nationally based key clients and the larger multidisciplinary project work that these clients require our solutions to deliver. In addition to the margin growth delivered from the better quality revenues, our more efficient operating model, implemented following the organisational restructure undertaken in the second half of FY24, has also delivered cost constraint, which has contributed to a strong turnaround in profitability. The $2 million PBT result represents more than $6 million in improvement at the bottom line. If we flick to the next slide, Michael, through the use of our data-driven analytics solutions and platforms, we're disrupting traditional industry methodologies, which in turn are driving more efficient, insightful, and valuable uses of the data that we capture. These solutions move us away from a commoditised, highly competitive landscape that then in turn create more value-adding opportunities. As I touched on just now, this strategy has seen us continue to generate improved gross profit margins year on year. We've underpinned the development of our skill set in digital and spatial analytics through a deliberate investment in talent and technology that is shaping new opportunities in our markets. As we've invested in building out our internal skill sets and technology over the last 4 years, we've seen this translate into continued growth in the proportion of revenue generated by a digital and spatial team. The growth in this digital and spatial revenue has been supplemented by the acquisition of Spatial Vision in the second half of FY25 that Michael touched on earlier. This has increased our revenue from our DNS service offering from 17% in FY24 to in excess of 25% in FY25. The higher returns that are following are allowing us to fund further investment in the development of our digital-based advisory capabilities and solutions, which are then flowing through to higher bottom line EBIT and PBT margins. Importantly, from our shareholders' perspective, our better quality revenue and stronger project margins that we've just discussed are also translating into improved operating cash flow and a stronger cash balance across the year. Our increase in cash has been driven by a focus on delivery of these higher margin projects, crystallisation of working capital through continuing to focus on our WIP and debtor balances, a focus on cost control, and also minimising our CapEx requirements by continued efficiency gains driven by the utilisation and mobilisation of our equipment across our national platform. This was particularly pleasing in terms of our cash balance, taking into account the cash that we outlaid for the Spatial Vision acquisition and the continued reduction in hire purchase liabilities, as well as the ongoing on-market share buyback that also occurred throughout the year. With the declaration of a full year fully franked FY25 dividend, once it's been paid, the business will have returned in excess of $3.2 million to shareholders over the last 3 years via dividends and the ongoing on-market share buyback. Importantly, also, continuing to build on our robust capital base positions us strongly to pursue further strategic M&A initiatives that complement our digital and professional services strategy. We'll continue to be active in this space, but as always, we'll remain highly selective in anything we choose to progress. Thanks, Michael. I'll hand back to you now.
Thanks, Steve, and appreciate those details. So if we look now at our outlook and our pipeline, I've touched already on that backlog of over $65 million, but the overall outlook is really strong. We've also got a weighted pipeline in excess of $190 million, and this gives everyone confidence about the outlook and the revenue growth for the business. It's underpinned by some really strong project wins, most recently highlighted by the Suburban Rail Loop project in Victoria that we announced, and there's been numerous digital and spatial transformational projects that we've announced through the year, showing that shift and mix in the projects that we have in the business. The former Spatial Vision team have really helped grow our government client base, and have expanded a number of those key opportunities we have in the business into different sectors. We continue to really focus on margin growth and not chasing revenue for revenue's sake. And you see the outcome of this through the improved returns to shareholders and sustainable, profitable growth, which is good for us and continuing to evolve over time in the business. If you look now, I'm not going to talk through all of our markets in detail today, but a couple of points to make here is the scale of the markets we're operating in. So all of these are showing significant ongoing compound annual growth. The addressable market for us in terms of work that actually Veris can do is significant across all of these sectors. And you can see opportunities across defence and government and utilities and some of the water sector that are big opportunities for us. And we've really targeted ourselves with groups of high profile blue chip clients in sectors that are growing and going forward, which has been a key element of our strategy. And we've now been able to start leveraging these advisory skills and digital and spatial capabilities and digital solutions into these parts of the market, which has been a strength for us. If we think about the summary then, if we look back through the year, not only have we grown the revenue of the business organically, we've done that and returned the business to profitability. After an outlier last year, we've been able to deliver a $2 million profit before tax to the business. And considering the ongoing transformation in the business, we think this is a really strong result. As Steve's touched on in a bit more detail, we've both used our cash for things like acquisition and the share buyback to really accelerate our strategic execution. But in doing that, we've also, our organic cash growth through operations has meant that our cash balance has continued to grow, which shows the robust nature of the operating model we've built. We continue to really invest in the business, and it's in a couple of areas. So we have our digital platforms that we're continuing to grow and take to market, and I think that's building out different levels of revenue stream for us. We're also building out high demand skill sets, building in new talent in the business and that integrated service offering, and that's positioning us for long-term sustainable growth as a business. You can see the success of our overall strategic pivot in our digital strategy, so that through the ongoing growth in our digital spatial revenue mix, going from what was single figures percentage a number of years ago, 17% last year, to over 25% of our revenue this year. And it's really shown the transformation in the business, but also the opportunities that there are for Veris as we continue along this strategic path. We've continued to grow our margin year on year, and that really showing the areas we're moving the business into, the scale of the projects, as I touched on before, the nature of those high margin, and the shift in the services we're providing. So that ongoing margin growth gives us strength in the business, and it's showing how the execution is continuing to work really well for us. And finally, that comes together with our confidence in our ability to pay our shareholders a dividend. That dividend is significant as a percentage of our returns for the year. We see this as a point of returning the business to strength and ongoing growth going forward. So overall, we think FY25 has been a strong year for the business and one that's demonstrated our strategic execution, the base of the business we've built, and the opportunities for us going forward. And that creates a significant growth and significant confidence for us in where we'll take the business going forward. So that's the formal presentation for now, Mark. So happy to take any questions or discussions you might have.
Yeah, thanks, Michael. We got a good few questions coming in there while yourself and Steve were talking, but I'm just going to take one that was emailed into me beforehand because they couldn't join us, so they're going to watch us back on YouTube on Monday. Just around, and it links into one of the questions that's in here on potential M&A. The question is, it's funny enough, here on Coffee Microcaps, we've had RemSense present, Pointera present, Aerometrics present, Rocket DNA present, and they're all talking about digital twins and this kind of digital spatial work. I would say maybe just a comment on, are you guys all competitors? Is everybody operating in different verticals? And further on the M&A point, is there scope for consolidation within the industry? I mean, these are just listed players. I'm sure there's another long line of unlisted operators in this space.
Yeah, look, it's an interesting question, Mark, and it's sort of I think there's a couple of elements in that question I'll answer first. So first of all, a number of the parties and others out there that you mentioned and others that you haven't mentioned, we partner with and we work with, because in many cases they're areas where we have complementary rather than overlapping skill sets or positions in the market, and there is opportunities for to work together or take those skill offerings into areas that we might want to do with our clients. I think from an M&A perspective, from our perspective, we sit here with a really strong balance sheet, organically growing profitable business, and our ability to leverage that up through mergers and acquisitions is really strong. Some of the other smaller players, I'd look at that and say, there should be room for consolidation. And one of the challenges of being a smaller business is how quickly can we execute on our strategy and how quickly can we capture the market that's in front of us. So we understand there's a big market in front of us. We understand also that those markets, particularly in the digital transformation sense, change really quickly. They evolve really quickly. So we've got to move quickly into those market spaces, and at Veris we're able to do that at the moment because of scale and profitability. As we're able to align acquisitions to help us accelerate on that, we're going to do that as effectively as we can. And a couple of key things for us though is we understand with the history of the business, prior to Steve and I, we can't afford for our acquisitions not to work. So Spatial Vision is a great example of a business that was aligned. It added to us strategically, and we see it being accretive really quickly this year. So that's a good thing for our shareholders and our investors. It accelerates strategy and gives them return. So what we're looking at now is other acquisitions at the moment that help us do that, help us build out the model, both in our digital strategy and our professional services space. And we've got a good pipeline of acquisitions there for us at the moment. We're working really hard on those, but we're focused on good returns for our shareholders, accelerating our strategy, and we're not looking to just take costs out of business. We're looking for accretive acquisitions that deliver on big synergies going forward.
You mentioned there, the split between the divisions, the digital and the consulting, and that's one of the questions here. Veris has had a goal of, it says, driving, digital share of revenue to be equal to historical segments, plus minus a third. Is this still the case, or can digital revenue continue to grow as a share of revenue, beyond the kind of medium-term target of a third?
Yeah, look, I would say that, we said sort of a couple of years ago that we wanted that digital spatial revenue to be equal to some, the traditional components of engineering survey and property survey. And we're getting effectively into that space at the moment. You look, our engineering survey and our digital and spatial businesses are about the same scale in terms of revenue now. That's a great demonstration of where we want to be. We now see the opportunity to accelerate beyond that. And we see the growth coming in our consulting and advisory business. And one of the key differences for us is we're not a digital-only business. We have that advisory and consulting part of the business that feeds the digital part, and the digital business feeds into that as well because it provides that differentiator. So we're lucky in the sense we see growth in both elements of that, Mark. We see that take us forward. We see that the position we're in now is we'll continue to grow out that digital and spatial revenue. What we're really seeing now is some of those different revenue streams coming out of our digital solutions, be it some of the analytics-based revenue, some of the managed services and other areas that you'll see significant growth on over the next couple of years.
Yeah, that leads nicely into the next question here. Can you give us an idea on which one of your products is, the real growth driver at the moment, and which one is emerging as a future growth product? I don't know if that's the bridgeside product that's kind of still to launch, or maybe one that's has been launched and is looking really promising from like early client feedback.
Yeah, look, I might touch on a couple of elements there. So we have Roadside is probably our most advanced of those digital solutions. It's targeted to a really big road condition market that's out there. and we've won significant projects in the last year based on our ability to provide that platform and that interface. And we've done that in the traditional road sector, but also the renewable sector around infrastructure development and also for government. So I think that is out there, and we're starting to see significant traditional revenue coming out of that, and now these other revenue streams. I think Bridgeside is the newest to the market. It's a significant opportunity. There's tens of thousands of bridges in Australia. They're a managed asset. If we can do that more quickly, more efficiently, and more accurately for the asset owners, there's a huge scale opportunity, and that's where we're positioned with a pretty unique proposition there. And then Vantage and Photo Navigator are smaller in scale in terms of each assignment, but their ability to scale up through the property market and into other sectors has been really significant. They've probably accelerated more quickly than we thought they would in the last 6 months. And so we're comfortable that all four will be active for us in the market over the next 12 months, Mark.
Yeah, I mean, I know New South Wales state government got a big project on all kind of regional bridges, like right across the state, big upgrading going on there. But as you say, that's like a managed asset that has to not just get the upgrade, it has to be looked after even after the upgrade. One maybe for Steve, since he did get up early there in WA, make it worth his while coming on here. Steve, margins, we've seen them tick up very nicely, like since the new management has come in. How should we kind of think about a sustainable margin, a target margin, over the kind of long term as the repositioning kind of winds down and we get into a more of a kind of a steady state operation? And I don't know if that's at the GP level, the EBITDA level, PBT level, whichever one.
Yeah, thanks, Mark. Look, I guess we're reluctant to sort of give sort of formal hard target numbers out there at this stage, given the sort of the evolutions continuing as we see the continued proportion of revenues driven by the solutions and the analytic platforms. Then we think they're at significantly higher margins, so we'll see that blend coming through, more and more so over the next couple of years. So I guess I'd categorise it to say, look, we've had a really good turnaround this year. We've driven sort of the bottom line margin to a couple of 2%. We're not satisfied with that, and we think there's opportunity and scope to continue building on that. And we'd look over the sort of the medium term to drive that further north into the sort of the mid single digits. And from there, it's really about the continued uptake and building on some of the advisory sort of capabilities that are really driving that higher margin flowing through as well. So I'd sort of probably leave it at that for now, rather than give sort of formal hard numbers. But that's certainly the aspiration and the target we're driving to internally. Yeah.
Okay. And obviously depends on the mix within the segments as well. The revenue that comes through the various divisions also going to impact that. Michael, maybe one last one. We've still got time to put in. I touched on it there in my intro to Steve's question. The repositioning, do you feel like that is kind of complete now, and it's now for the yourself and Steve and the broader management team now it's really about pushing the growth levers within the business and driving new business development rather than trying to fix the business to get it into a state of, okay, now we can grow it? Do you feel like that kind of part of the Veris story is now complete and it's now more of a growth story rather than a turnaround story?
Yeah, that's fix is a pretty interesting word, Mark, and I think that's probably a pretty apt word of where we started. And I think now we're able.
I'm trying to be politically correct here.
Yeah, no, you're doing really well, and I'll try and do the same. Look, I think that the base of the business is really strong and stable now. You think about it, the areas we're in our property surveying business, they're strong, they're growing, they're profitable. We're repositioning our engineering survey so then they're not chasing volume and they're getting good margin. And the suburban rail loop win was really transformative in the sense of how they could go to market. Having that base lets us accelerate the broader transformation, and that is the consulting and advisory growth, which is high margin advisory work at the top level with clients, and then this digital transformation. And we're able now to fund that growth and that transformation off the base of the business. And the further down that track we get, as Steve touches on, more of that margin comes back to the business, more of those transformational digital solutions revenue types come in as well. So I think we have moved past the fixing. We're in the transforming, growing differentiation part of our strategy now. Many people have said to us, gee, you've done the hard work. Well, actually, I think transforming and growing and really doing, differentiating the business is harder than fixing, because it's now about taking those managed risks, trying different products in the market and doing that at scale and at pace, which is the interesting opportunity in front of us. And, I think we've got some good people who are pursuing that really effectively at the moment, and we're all pretty confident that we'll see the progress they'll make.
Michael, we're actually bang on time, so we'll leave it there. Thank you very much, and thanks for Steve for joining us as well this morning. And hopefully we can get you back in at a later stage in FY26.
Thanks for the time, and thanks for everyone's interest. See you, Mark.
Yeah, thanks, Michael. Thanks, Steve. And we'll quickly move on to our next presenter. I'm delighted to be welcoming back Sam Budiselik from Cash Converters. Sam, good morning.
Hey, Mark, how you going?
Good. Sam, if you want to pull up the results deck, I'll let you know when I can see it on screen here.
Let me do that.
I can. I'm not sure what number slide that is, but I can see
Sorry,
the global
How's
store
that?
network. Sorry, there we go. Yeah, there's the cover slide now.
Yes, thank you. You hear me okay, Mark?
Yeah, your audio is good.
Great. You're good for me to go?
Yep, you can take it away.
All right, thanks for having us. Good to see you again. And thanks to everybody for listening. We've had a good year at Cashies. We've been through quite a bit of change, and it's exciting to be back to talk to your listeners, Mark. I thought we would just touch on, with the start of our presentation, a bit of a recap as to our model. It has changed a bit over recent years. We do still run a store network, a physical store network, and we're very focused on the markets of Australia and the UK at this stage, where we operate corporate and franchise stores. And we'll talk about those numbers in a minute. The store network is important to us. It does help us reach our customers, and it does generate a better quality borrower through our lending business. And over time, we've been growing that store network. The corporate-owned store network's been growing as we've been acquiring our franchise stores back as a part of our strategy to continue growing our earnings. And we've been growing the network as well with some new sites and a new luxury-only model that we'll show a photo of in a bit, which has been great. On the lending side of the business, we've really taken a big strategic step in a different direction on our lending business. And we've announced that we're exiting, the payday lending product, the small loan product that we have been offering for many years, and our vehicle lending business. And that really is to allow us to focus on a new sort of customer with our lending business. And we're seeing through the results, the transition of the loan book playing out very nicely in terms of our loss rates, our bad debt expenses, and it's opening up a number of other opportunities that we'll talk about. So very excited with how that deliberate strategy to sort of change the composition of our loan book and bring in some additional store earnings has helped to sort of smooth this lending transition that's underway, and that's performing really well. On the retail side, the model is changing a bit. There's definitely a global interest in what we're sort of terming luxury repurposed or pre-owned inventory around the handbags and the watches and consumer electronics and jewelry. And we're seeing that play through, and that's providing a fair bit of benefit to our store segment. And just as a reminder, we're a big volume player. We're purchasing 1.7 million items a year. We're processing 500,000 loan applications a year, and we have about 80,000 active borrowers in our loan books. So, big, well-known brand and a big business. And we've just declared another half 1 cent dividend to make it 2 cent annual dividend payment for the 5th year in a row, fully franked, which I think in the small cap market is a good outcome. Just moving to the strategic transformation slide number 3. in the presentation. Look, I like this slide because it's sort of putting simply what is a pretty complex change that we initiated 12 to 18 months ago. We've really had to work on product innovation and engaging our network, particularly our franchise network, and rebasing our commissions for our lending products. But we really had the view that, I guess, rather than sort of pushing further and further with the small loan product that we were offering, if we pivoted our business away from that, we could grow a new loan book. We could reach new customers that I think a new modern brand is attracting. We could de-risk our business and potentially bring down our funding costs. And we've got the two books running down, the payday and the vehicle books running down as anticipated, and we're growing the two new books, the medium book and the line of credit. And we're just unifying an offer to a customer of a cashies loan going forward. Depending on your credit profile, you'll end up in the lowest cost, the best option for you. So nice and simple. And those books, we've really been through the reposition now. We're into a growth mode where we're going to be growing those books, and particularly sort of through October, November, December, when we have a very busy period leading into Christmas. You'll see some new content, you'll see a new offer, and our customers will see some new technology deployed to them through our web portal and our app. And I think the complexity of sort of running books down and managing loss provisions and rebasing our lending facility have all been great and worked out well. What we deliberately stated, probably 2 years ago, really, we started acquiring our franchise stores in Australia and the UK in a big way. So in 2021 financial year, we set up an investment framework. We started buying a couple of stores, just making sure we could value them accurately and we got our forecasting right. And that we saw benefit having acquired them and putting a bit of capital into them, that we could grow those acquisitions and that they made sense from an earnings perspective. And having established that, we've started accelerating. We made a 42 store acquisition in the UK in FY23 from memory. And that really established a UK European base for us, where we've got some corporate and franchise stores, and the same in Australia and New Zealand we picked up as well. So, we're pretty committed to continuing that process. It's working well. We'll keep buying those stores. We like not only adding the earnings that we're acquiring, but also it gives us an opportunity to add some more stores around the stores we're acquiring and to, just give our customers a more consistent service offering. Obviously, the UK is a big growth market, as is Europe, and we can talk a bit about that on the next slide. And you put those two things together, and all of a sudden we're into a different funding conversation in the market. The small loans are, with that regulatory risk that they bring, funders are reluctant to fund those loan books. And for 10 years or so that we've been doing that, we've been offshore with our securitisation facility, and announcing these changes is opening up some new conversations we're pretty excited about looking forward in terms of reducing our funding costs. Just to briefly touch on our store network before we jump into the result. As I mentioned, the yellow bubbles are our corporate stores, our company-owned stores in the UK, Australia and New Zealand. The blue bubbles are the franchise stores still in those locations. So they're logical acquisition targets for us over time as we just fold them into our operating framework. And, really all we do is transfer employment contracts of staff across, and they look and feel and match our corporate stores in many instances. And at times we give them a lick of paint and put a bit more inventory in and get those loan books growing in those stores. So that strategy's worked really well, and that will continue. And I think with the capability we have in the UK now to look a bit wider into Europe, where we've sold sub-licenses to Belgium, France and Spain, where there are significant networks operating with our franchise partners, we could potentially sort of buy those countries back and fold them into Europe as a logical extension to what's been a pretty successful acquisition campaign to date. In terms of our financials, we've had a really strong year, I think, in consideration of switching out, some pretty high margin products to more sustainable, lower margin, lower loss products. We were pretty happy to hold revenue flat. It wasn't really a target, but that played out quite nicely. But what we've really been super happy about is our earnings quality and increase on the previous year. So we've managed to, lower our loss rates a little bit more than we thought, release a bit of cost out of the business that will keep going. It's very costly to originate small loans, and you can imagine, if we're only approving sort of 10 or 15% of that loan flow, for every 10 applications you're assessing, you're turning 9 away. It's a costly exercise. So the strategic pivot has allowed us to release some cost that will also hopefully bring that funding cost benefit over time. But adding in the franchise acquisitions and shifting the inventory mix in the stores to slightly higher margin luxury inventory is starting to now feed through our earnings lines, which is something we've really been focused on delivering. As a result, we do generate good free cash, and we've built a pretty substantial cash balance on our balance sheet, and that just gives us the flexibility to continue our capital program, being utilising cash in Australia for some franchise acquisitions and offshore in the UK using bank debt. Now that we've got a Lloyds Bank facility there to facilitate some acquisition growth, puts us in a really strong position. And the business, as we keep driving our strategy and executing, we see that free cash continuing. And I think ultimately, as we grow into a bigger network and as we acquire and consolidate in our core markets, UK, Europe, and Australia, the business gets bigger, the earnings get bigger, and the free cash gets bigger. And I think over time it becomes, an opportunity to start to think about increasing dividends. Our loan books in the past, we have always focused on growing gross, and I think you're kind of hearing that we're starting to optimise now for profitability, and a slight reduction in loan book was planned, and we'll see loan book growth returning into FY26. Turning to slide 7, the growth through transformation slide, I think underlining all of this, really what we set out to do when we went offshore is definitely to do that in the right way. And I think the business we acquired, we knew the management team and regarded the management team in the UK, and they brought a capability to continue expanding the UK and into Europe over time. But to have 30% of our revenue coming through that UK line from really nothing in 21 has been terrific, as we just diversify geographically, and that offset some of the loan book rundown as we now sort of start to grow those loan books. That's played through really nicely. Good, clean EBITDA and net profit growth is obviously really what we're here to do and achieve, and doing that by really dialing in our loss rates and repositioning our loan book gives us a really good handle now on growing new books into new markets, and really being able to take a bit more risk where we choose to if we think there's an opportunity, or dialing the risk back if we think there's a change running through the economy that may provide a risk to the loan book. So all of that's really, there's some good metrics there, just sort of, I think, underlining that the strategy is working and what we're doing is working well. From a segment perspective, for the first time in a while, we've really seen the store segment starting to hit its straps. Good EBITDA growth and meaningful gross EBITDA contribution, and there is some franchise growth in there as we've acquired, but our gross profit margins are lifting, and in FY25 the gross profit margin lifted from about 47% the prior year to 51%, just as a result of a better mix of inventory. Definitely a bit of a benefit from gold prices increasing. Not that we're a big trader, not that we sort of take a position on the gold price, we just buy and sell gold, but it's certainly having a good benefit through that store network. And that segment really has operating leverage now. We don't need to add a lot of headcount or cost overlay to keep growing revenue, and we're very focused now on growing revenue and earnings in the store segment and continuing to capitalise on that momentum. The finance business, as we touched on, we expected earnings contributions to drop a bit as we repositioned the book. So it's all in sort of as anticipated. I think still performing really well. Our customers are performing well. Unemployment remains low. Cost of living still elevated. We're seeing strong demand through the business, and offering people lower cost borrowing options is really what we've been trying to innovate. And most of our customers, we've been able to take on that journey, which is terrific. Vehicle financing, by design, as we're running that book down, because we believe we're better focused on the new loan books that we're building direct to our cashies consumers. That's still a contributor to our earnings profile. By design, it sort of softens the transition out of the other loan products, as we've taken all cost out of the business and we're just running that book down really to plan. But the UK is one that really, in recent years, wasn't contributing a lot when we just offered a franchising model system over there. Now having company stores in the UK, the EBITDA contribution is growing significantly. That's about 20% of our total EBITDA now, and it's growing at a decent clip. And it's a big market that's performing well and growing strongly. So we're really excited about the UK and the wider European opportunity that we do have in front of us. And New Zealand, I think it was just good to turn New Zealand, to be honest. The New Zealand, the economy, as everybody probably realises, was struggling a fair bit the last few years. And, we really just rebased our loan book, took risk off, and have, fixed that business, if you like, to make a reasonable contribution that will just grow at a steady rate over time. So just in terms of our outlook, Mark, I think it's pretty simply more of the same. Unifying our lending product and making a cashies loan offer to a customer, I think, is a lot simpler than what was pretty complex in terms of the regulatory environment with the other loan products. So a good, clean, simple user experience. We're going to get back to really digital marketing again to get the loan books growing, to complement some of our above-the-line advertising with the AFL and some of the other sporting events coming up. That works well for us, attracting new customers. We're going to continue acquiring our franchise stores in Oz, Europe, and the UK. The luxury-only format store has been, we piloted a store in Bondi, just capitalising on the interest in this part of the market. And we've established a store I'll show a photo of in a minute, but it's only luxury inventory in this store, quite unique as a pilot. It's been a huge success, certainly attracting a new customer. Still cashies branded, but a high quality fit out, high quality inventory, starting some good social engagement and conversations online. And we're planning to roll that format through the capital cities in Australia in this financial year and establish some pilots in the UK too. We do see that being a good part of our retail network growing strongly. Interestingly, the banking environment, like I say, with the product shift in the lending business, we're certainly having different conversations onshore here about better funding costs, I'd say. In the UK, Lloyds have come to the table to fund store acquisitions, which has been terrific, and we're hoping to continue growing that facility. And just the wider European bank support for our business is certainly there based on the conversations we've been having. So I think the Australian market's a little bit behind where the rest of the world is in terms of supporting all sectors of our economy, and there's been a bit of pressure for that to change. And then we're seeing the benefit of that. And with our product strategy change, we're certainly looking to capitalise on that, which is terrific. And always focused on fairly conservatively managing our balance sheet, growing our earnings, and continuing to pay the dividend that we have been for 5 years. Just briefly, in terms of the store acquisitions, we often get asked sort of how we look at that. We have good visibility of top line earnings for the stores in Oz and the UK on our platform. We then sort of build up a corporate cost profile and determine a corporate EBITDA if we owned that store, with the number of people that we'd employ in that store and the way we'd run it, what would we make? And then put a multiple anywhere really from 3.5 to 5 times EBITDA, depending on the size of the network and the strategic significance. But that's been working really well for us as we've been buying like that. And we do find 12 months later we're getting a better return out of that store, operating it as a corporate, where we're funding the loan books and we've got really capacity to grow inventory and turnover. But we find that rather than making the 50 or 60 grand in franchise fees that we get, which is pretty fixed under our model, being a corporate owner of that store, we can obviously grow the bottom line contribution well beyond that on an average basis that you're seeing there. And the contribution of these new stores is now starting to feed, and we really want to keep a focus on where we can accelerating that. This is a picture of the Bondi luxury store. It doesn't really do it justice because when you walk in, it's really a bit of a wow factor, and the feedback is really unanimously, gosh, this is just not what I expected a cashies store to be like. And look at this inventory, and my God, I didn't know you guys did this and that. So as a major store network operator of pre-owned luxury retail, it's quite a unique service offering. And what we find with these stores is it attracts a new customer that then will come and not only sort of purchase and maybe exchange jewelry and provide inventory that they've got into the store, But you just see better lending going on through that store too. We do get better personal finance demand off the back of the improved retail turnover from that store. So I think one in each capital city really feels like a nice way to start to build that part of our network out. And this store here does buy more inventory than it can sell, and we can put that inventory out to some of the other surrounding stores and start to seed that luxury in all of our stores, and we're really excited about doing that. I'll finish there, Mark, with just a couple of points as to why we think we've got a good future, we've got good momentum, and why we think investing in cashies right now is a good opportunity for investors.
Cheers, thanks, Sam. And I'll just pick up on your comment on the dividend. I've done a bit of work on this in the past, and only about 10% of microcaps on the ASX, if you say that's anything capped under 300 or 400 million, actually pay a dividend at all. So you're in the top 10% on that metric, at least, anyway, Sam. Maybe if we just I want to start kind of where you finished on the luxury store. A question around that: will that be rolled out, these capital C's, just within the corporate network here and in the UK, or is there scope for motivated franchisees to also maybe convert where the locations make sense? Obviously, this is not going to be a complete revamp of the store network. It's going to be very location specific. But, is this going to be a corporate only exercise and excluding the franchisees because you want a bit of differentiation maybe? Or is it something that, for the right franchisee in the right location, you're happy to support maybe a conversion from the traditional store to this new model?
Yeah, great question. I think there's a few elements. Firstly, the general store footprint is coming down. So yes, we do still have some of the super suburban stores out offering everything, but in general, we're seeing our portfolio footprint come down and leasing costs come down, and wage costs come down as a result of having the smaller store format. We call it like a hybrid between a luxury only store and a full service store. We've got to go hybrid. It's a bit of a blend. So that's been beneficial. These luxury only stores, to your point, you're right, Mark. I think they're kind of location specific. We think 3 or 4 maybe in New South Wales, 2 or 3 in Victoria, maybe 1 in the other states initially would sort of be the number that we'd stand up. Interestingly, talking to the Franchise Association the other day, they were kind of impressed that corporate had gone out and done this and made it a success. They kind of had the view that the franchise network normally innovates, and the McCafe coffee came through the franchise network for Macca's and then corporate copied it. We've sort of been watching how they operate and adopting a lot of what they do. And this one sort of caught them on the fly a bit. They were like, oh, wow, you guys just went and did it, and wow. So we're open to them doing it. A couple of the bigger operators have expressed some interest in standing up some of these stores, and we'd encourage that. We will keep an eye on we don't tend to control a lot of what they do other than the fit out standards and the specs, and these ones will be all over if they go and do that. There's one group in Oz that's talking about maybe doing 1 or 2 in Queensland, which we'd support, and there's a bit of chatter beyond that. So we're really committed to the corporate rollout to get these established because we believe in them and they're working. It's working in Bondi, and they're taking that offshore. But yeah, we're open to the existing franchisees considering it as well.
Okay. And then the runoff loan books, I think we've discussed this before, but I think maybe good to get an update in case the thinking has changed. I know you've said in the past, you're there's no costs associated with him. You're happy for them to run off. But if an opportunity came to, where you could offload those in order to fund, the rollout of these new stores, or, a chunky franchise acquisition where, there's 10 or 12 stores from one operator who's retiring or, is looking to sell, and, to kind of match the capital needs of the business. Maybe just talk about those runoff loan books. Is there a point where it's actually better to just sell them and get them off the book and have the dry powder ready?
There could well be. Look, I think number one, we've acted decisively, and I really think it was a huge move. It took a lot of work to get all of our stakeholders aligned. And when you've got franchisees, you do have to give some consideration to the impact of the product strategy change to their businesses, i.e. you need to develop other product to, keep the customer and meet that need. So I think the move was it was one of the more painful ones where we just thought if we rip this Band-Aid off, we can pull back and reposition and then we can really go. The runoff of the loan books, always wanting to sort of maintain that earnings momentum, and I kind of felt like if we could say to the market, we'll get some profit growth, which we've seen, which is awesome. We'll take care of the complexity. We'll get those books running down. They'll get to a point where we may choose to pull the trigger to offload them if we had a compelling finance offer, and we'd come to the market and say, look, we're selling it because we can go off and do this. And I think that would then make sense. So certainly open to all sort of options, and having conversations around those options is great. But we feel pretty comfortable at the moment with the runoff, particularly the small amount credit contract, that payday loan. Even sort of announcing that we were ceasing origination has the big four banks back. It's really quite remarkable. So we've kind of really made the change we need to make to now give us the optionality. If there was a good, compelling reason to sell them, we would. In the meantime, we run them down, and everybody's pretty comfortable with that. And the refinance sort of conversations that you can have around the securitization facility start, and they take a while anyway. So not in a rush, but good optionality.
Yeah, it leads nicely into my next question in terms of not the UK side of the business, but the Australian side of the business in terms of, financing conversations. More how you would see the shape of the financing coming through. Would it be securitized warehouses, an open-ended maybe club facility with, 3 or 4 banks, spreading the risk profile, between them, given they're kind of engaging with cashies for inverted commas the first time, if that makes sense, rather than doing one deal with Westpac, maybe it's Westpac, NAB and ANZ, for example, just to throw out an example.
Yeah. Look, I think engaging with Lloyds was great. It certainly sort of made the banks back home sort of sit up and take notice. I've had some conversations with the European banks that are very positive too, and there certainly appears to be no reluctance to fund our customer segment in Europe and the UK. It's very, very much regarded that we are a bigger operator and we have full support, and it costs much lower than the banks are offering in Australia. So terrific. In Australia, I think we've got a $200 million securitization facility. We could probably club that now. Whether we choose to go with one, that if we could have a compelling offer from a bank, a lender, that might include some working capital to acquire some stores, for example, it might be a bit more compelling to, go with one. But, in Europe, they're talking about club. I think the whole conversation's just really changed now. So we'll sort of sit back on this a bit. We'll hasten slowly. The interest is great, but I really want to make sure that not only do we get the lower funding costs, but we get the flexibility. And particularly if some working capital could come into the Aussie business as it has from Lloyds in the UK, that could be another reason to sort of start to, preference a lender. But, I feel like for the first time, we're kind of on the front foot. We're throwing everything at this, and it's just great to have a different conversation and different funders involved, that's for sure.
Yeah, we had BNK Bank on as our first presenter, and we also had a discussion there just about the private credit, private debt. Just it's a very hot asset class at the minute. Across the finance industry. So, definitely, I'm going to choose my words carefully. Different debt profiles and debt products are there's definitely more open-mindedness to it than I think it was even 12 months ago. I think the market has shifted quite a lot in the last 12 months. Final question, Sam. In terms of the European markets that you talked about, is there scope to push that into even more markets, or is the ones I think you mentioned French Belgium, and I can't remember the third one. Is it,
Spain,
see how those kind of three or four go before, moving maybe into other European markets?
Yeah, look, I think we've got a lot of opportunity in Oz and UK Europe in terms of engagements with our network, our franchise network and partners now. And, I think we could probably, put $100 million to work on the same sort of terms we've been talking about as we're acquiring in Oz. And, that's a great opportunity for us. It's a low risk. They're on our platform. We don't have to integrate them. And, we're really focused on that. I do think the European three around the UK, Spain, France, and Belgium, really good networks, well run, been around for a while, established. Diversify our product mix a bit because they're a retail and pawn markets there culturally. Pawnbroking's quite big in Europe. Again, they're good opportunities. I think beyond that, if you think about Italy, Germany, some of these jurisdictions where I think the model would work well, we could consider, establishing a new kind of structure, a JV kind of arrangement with an operator in those markets and seeding them. That might be something that we look at. We wouldn't look to go and deploy capital into those markets to establish corporate networks necessarily, because I think what we're building in UK, Europe, and Oz now is substantial, and it will take a little bit of time to execute, and for us to sort of get the capital structure right. But if we could seed some growth opportunities in some new territories with the right partners, we'd be open for that. So yeah, I just think, Mark, there's so much opportunity in the next sort of 2 to 3 years for us to continue executing as we are now, blending in a little bit of bank debt and some cash equity out of Australia to keep those store networks growing in those markets we've called out. We'll then turn our focus a little bit wider in Europe over time, but it would be pretty core, the countries that you'd probably expect, not too far into the Eastern European bloc at this stage.
Yeah. Okay. More Western European focus. Okay. Sam, we'll leave it there. Thank you very much for joining us once again and for getting up, well, reasonably early there in WA, but thank you.
It's not too bad, mate. Good on you, Mark.
Thanks very
Thanks,
much. And we'll hand over to our final presenter of this morning's session, Stephen. If you're still on mute there, if you could just unmute yourself, please. Your video is looking good.
Yep, thank you, Mark.
Your audio sounds good now, Stephen, as well. If you want to share the results presentation deck, I'll let you know once it's up.
Okay.
Yeah, it's just loading now, Stephen. Yeah, I can see the cover slide now, Stephen. You can take it away whenever you're ready.
Great. Thanks very much, Mark, and thanks everybody for being on the webinar today. I'm going to talk to you a little bit about Trajan Scientific and Medical, a business that we founded back in 2011 that services the global analytical science industry. So let me talk a little bit about who we are and what we do. There are literally hundreds of thousands of laboratories around the world that are working to measure samples every day of the week. What are those samples? They could be things like drinking water, human blood, soil, food, but those laboratories have instrumentation, and those instruments are designed to reveal to the scientists in those laboratories what's the composition of those samples. Is the drinking water clean? Are there biomarkers in the blood that we wanted to detect? Is the food safe? So these measurements happen all the time, and many of them are not discretionary. They are required by law, by regulatory requirements around the world. And what does Trajan do? Well, we're an industry tool provider, is the way I like to think about it, in that in those instrument platforms that are located in those laboratories around the world, there are many critical components, consumable items that are used that enable those measurements to happen. There's also robotics that are used to process those samples and to enable them to be measured. So Trajan is a manufacturer, a designer of both those consumables and also some of those robotic platforms. We've grown from a starting point in 2011 to today being about 650 people worldwide. And we have operations in North America, in Asia, in Europe, and we truly are a global business. Sometimes people ask me, what's the geographical mix of Trajan's business? And the way to think about it is really pretty much by the GDP of all the countries around the world. Australia actually accounts for just a few percent of our total business. Our largest geographic market is the US, followed by Europe and then by Asia. Now, strategically, what's the business about? Well, one of the things that we observe is that the measurement of these samples, particularly those that relate to our biology, the environment in which we exist, and the food that we consume, all contribute to our understanding of human well-being. Indeed, many things that happen today are more about opinion than necessarily data. And our view of the future world is that data will become increasingly important. And that's driven our strategic focus that has been behind our product developments, the acquisitions that we've made along the way, to arrive at where we are today. The business is divided into these three segments. The first segment is our components and consumables. And so the first thing to understand about that segment is that these are mission critical items. They're not commodities, they're not disposable, they are multi-use devices, but nonetheless, they are consumable. And today, that's about $100 million in revenue within the Trajan Group. And indeed, that segment has been our economic engine over the last 14 years. It is a recurring revenue, it's predictable largely revenue, and it generates a lot of the cash flow that enabled Trajan to expand and develop the way that we have. Part of that expansion in 2016 took us into the field of robotics. And so the capital equipment segment now accounts for about 1/3 of our revenue. And it's involved in the handling of very difficult samples that exist in these laboratories. And we make possible some of the measurements that otherwise could not be done. For example, one of our leading platforms allows scientists to understand the behavior of proteins and was utilized in the development of some of the COVID-19 therapeutics because it is truly at the leading edge of structural biology. So that hopefully gives you a bit of an idea about those two core segments that we have in our business. And the third is one that is much smaller, but nonetheless, we highlight it because it's what we call disruptive technologies. We pursue R&D in a business as usual fashion in our current segments, but then we address this area of disruptive technologies a bit differently. So here we have things like sampling devices that can be used in the home, because we imagine a future world that's in line with this idea of a personalized, preventative, data-based healthcare. And to enable that, we need to provide ways that people can take their own samples to go back into laboratories. We're also developing some unique miniaturized capabilities in this disruptive segment as well. So that's, quite a separate part of the business, but it's part of our long-term view. We reported out yesterday our fiscal 25 results, and we reported record revenues in fiscal 25, now just approaching 170 million. Our growth rate is outpacing the growth rate of our segment in general. And across the growth, you can see that it's not isolated to any particular product or any particular customer. The growth last year was truly across multiple product lines, across multiple customers and across multiple geographies. In terms of EBITDA, a normalized EBITDA 15.5 was up about 26% over the prior year. Still a bit short of where we would have liked it to have been, but there's some good momentum there that we take into the current financial year. And our gross margin was a little bit down compared to where we would have liked that to have been as well. What happened there was that in our capital equipment business, we saw some significant growth for food safety testing in parts of Asia. Indonesia, Malaysia, China. And some of our equipment is provided to those geographies through distribution arrangements where there's a splitting of the margin. And that caused a bit of a dilution last year, but it's quite unusual. We wouldn't normally expect to see that type of mix compared to our direct selling activity. On the balance sheet, we've reduced our net debt now to below 30 million. Our leverage ratio now is below 2, and we've put in place some pretty solid backing in terms of our banking arrangements. So our balance sheet's in good shape and ready for the next stages of the growth of the organisation. This slide here shows you a little bit about our business model. We do selling directly, but we also are highly collaborative with the industry partners. And what I mean by industry partners is some of the leading multinational corporations who are providing those instrument platforms into those laboratories around the world. It's part of Trajan's DNA to work closely with those companies. And the reason is that's the world that I came from. It's the world that a bunch of the Trajan leadership team came from. So we understand those global leaders, very well. And the way we partner with them is that when we're looking at our technology and thinking about these target areas that relate to human health, clinical, pharma, environmental, and food, we go down a pathway of looking at how will we design or develop the next solution that solves an analytical problem. It might be about sensitivity. Can you actually detect the thing that you're looking for? It might be about laboratory productivity. Is the lab working through the sorts of numbers of samples they need to do on an economic basis? And when we have that technology ready, we then sit down with our partners and look at how does that technology service their strategic intent and their overall direction. And that's the way we work with them. Sometimes when people hear about these partnerships, they misunderstand and think that Trajan is a contract manufacturer. Trajan is not a contract manufacturer. These partnerships are based around our IP, around our strategic intent, and indeed it allows us to scale our business in a really effective way. If I think about our largest OEM partner, a decade ago, our revenue with them would have been about 3 million. Last year, it was about 30 million, but we still have just one account manager because we're able to interface at all levels of that organization and channel that through one account management structure. So that gives you an idea how we operate in this marketplace. So what are the key bullets to take about our current trajectory? First of all, we go into this financial year with some solid momentum. And as I mentioned, that momentum isn't limited to any particular customer, geography, or product area. It's across the board. The second thing to understand around us being a precision manufacturer is that part of what we do is we look at some of these core and critical devices and components and consumables, and we do two things. One is we look at to what extent can physical precision further enhance that product's ability to guarantee the quality of the analytical data in a system. And secondly, what we've become incredibly good at is how do you then manufacture that on scale? If you were to visit any of our manufacturing facilities around the world, increasingly you would see automation at play, but it is automation that is our IP, that is designed and developed in-house by Trajan's engineering teams. And it's another competitive advantage that we have compared to any of the smaller players that exist around the world. The third bullet point there, we're probably all quite familiar with some of the changes and some of the volatility that exists in the macroeconomic setting today. And one of the things that's driving Trajan to do is to now look at in-region, for-region type activities. So, for example, we might be scaling up some of the activities we do with our facilities in the US for our US customers. We've also started to scale up some of the activities we do in Asia for our Asian customers. If I went back a few years ago, our core business model was around the assumption of global centralization, whereas today we're very much thinking about polarization and pursuing in-region for regional strategies. This presentation, by the way, is available on our investor site, so I won't go through every slide in a lot of detail because we would run out of time, but they're the three key bullets that I wanted to highlight from that particular slide. Some of the highlights from this year, just to touch on briefly, we went down the pathway of globalizing our capital equipment business and really pleased with the way that works now. It's being supported through some new revenue streams in service, in software, and so forth. We've also focused on bringing some new higher growth, high potential product areas into the mix, and we've seen some good initial momentum around those. We made an acquisition last year of a SaaS product that we've now taken to market and starting to see our first commercial translations there. And we do have an ongoing activity around product variations, product extensions that continue to renew and add vitality to the portfolio. I won't go too much into this, but that gives you an idea of one of our disruptive technologies. Might not mean much if you don't have a scientific background, but suffice to say, it is a modular, miniaturized platform that performs the same duties as some very expensive and laboratory-based systems that exist today. Going into our segments, this is our components and consumables segment. By half, you have revenues. You can see we had a record second half of the fiscal year, just under 54 million. There's some ups and downs over the journey over the last few years, and I can come back and visit those if you like, but they're more about market dynamics and stocking and restocking cycles rather than the underlying demand. If I was to impose upon this chart the rate of underlying demand, it is far more a consistent growth curve that you would see. So there's some healthy activity there in the components and consumables, and you can see actually that the margin continues to expand in that part of the business as some of our margin expansion initiatives have been rolling out in our different facilities. Capital equipment grew by nearly 10% last year, but you can tell that the gross profit margin took a hit. And that's about a 5 percentage point hit for a segment that represents a third of our business. And that, again, was very much about a flip last year in terms of direct compared to distribution sales. And it was quite extraordinary. I'd be surprised if we confronted with that same dilemma again this year. But nonetheless, it did have a negative impact on the margins for this segment. Then the disruptive segment. If we go back a couple of years ago, we were investing up to 4 to 5 million into that segment. Last year, the losses in that segment were reduced down to just 1.5 million. In fact, the micro sampling part of that portfolio, we made a commitment to the market a couple of years back that by now that part of the disruptive portfolio would be at least break even. We've achieved that goal. In fact, it's probably a bit better than that right now. And so the remaining investment is really now in this portable and disruptive platform that I highlighted earlier. I won't go too hard into the cash flow summary, but suffice to say that the business is a strong cash generator and typically has a cash conversion ratio around the 1 or so. You can see last year 105, this year 0.9. And that gives us good predictability around how we manage our global cash flows across the group. Thinking about now as we go into this next financial year, there's a lot of volatility out there, particularly when we think about the way that tariffs are being used as negotiation tools, if you like, in terms of them being off again, on again, escalated, de-escalated. And so that's a factor that we're dealing with. And in some ways, we're well positioned compared to some of our competitors to deal with that because of our global footprint and the multiple sites we have in different jurisdictions. There's also been significant reduction in the funding going into government agencies in the US, such as the NIH and the CDC. Those government agencies do fund research projects in science, and sometimes those research projects are utilizing our equipment. And so we are seeing some impact of that. At the moment, though, we're seeing growth in other areas that's offsetting that. So it's a bit of a neutral playoff at the moment in terms of the upside and the downside of some of those factors. The business here at Trajan is incredibly resilient. You know, one of the things that we noted as we went through the global pandemic was that the underlying demand for our components and consumables really did not go away. They are non-discretionary measurements that need to happen every day, particularly in environmental and in food analysis. So that gives us a good underlying strength. We are rapidly pursuing this region, in-region for region strategy, and we've already established new capabilities in our Penang, Malaysian facility to do with that. And we have some work to do, but we're making good progress in terms of further margin expansion through the deployment of production automation in our Melbourne facility. And we've also transferred a lot of these Australian-based activities now into our lower cost platform in Penang in Malaysia. But we have some work to do to really realise the benefit of that in terms of productivity gains. I'll skip over ESG, but suffice to say that we're on that journey as well and making some progress. Stepping into the next financial year, the one that we're now embarking upon, we've provided some guidance to the market. We were relatively cautious about doing that given the volatility of the setting. The message we wanted to give, though, is that while it's a cautious guidance we've provided, the outlook from our point of view says that we still intend to grow the top line, intend to grow the EBITDA line. And in fact, we're covered by 4 analysts out there, and so they give a really good update. They've been published today. Bell Potter, Ord Minnett, Canaccord Genuity, and Taylor Collison all cover the Trajan stock. We're really happy with the analysts that we work with there. They seem to know us quite well now and provide some really good additional information about Trajan. So I think, Mark, that's my 20-minute mark. I might stop there and see if you want to transition now to Q&A.
Yeah, thanks, Stephen. We got 2 questions come in there just as you were talking through your slides there. And the first one is, do you expect to incur restructuring costs in FY26? And if so, can you maybe give a sense of how that much might be?
Yep, quite happy to answer that. We're not planning any significant restructuring costs in this financial year. I am mindful, though, that we are looking at globally to what extent do we need to be thinking about further site consolidation, site rationalisation. So when that comes about, there could be some restructuring costs coupled to that. The only other thing that fits a little bit into that restructuring mode is that we are establishing new capabilities in our region for region strategy, but none of that is material in scale and shouldn't have a big impact on this year.
Okay. And next one is the 4.1 million spent in CapEx in FY25. How much of this is in relation to the Mass Spec Studio acquisition?
None of it is related to that at all. We typically have about a 4 million per year CapEx spend that relates to production, renewal, maintenance, and so forth. So that is a normal CapEx level for us every year.
Okay, perfect. And then another one, and you've kind of slightly touched on it in the result. Just a question on a sense of the margin differential in the capital equipment business, between you doing direct sales yourself versus working through those distribution channels.
So some of the distribution arrangements that are in place are receiving in the order of a 30% discount. So it is a significant difference. The reason that we have those arrangements is that we acquired a company in Germany in 2021 called Axel Semrau, which is now part of our capital equipment business. And those arrangements were in place when we made that acquisition. So they are legacy arrangements. They haven't been particularly problematic until this last year when we saw that regional shift in the business. Of course, now the magnifying glass is on those. What are we doing? 2 things that we're doing. First of all, it's quite normal in our industry, if you have a capital equipment business, that you enter into emerging markets, first of all, through a distribution partnership, and then you typically down the track look at going direct. And in some of these markets, that's part of our plan. The second element is that it's a project right now just to look at the commercial arrangements with all those partners and to make sure there's fair and reasonable value splitting based on what activities they're engaged in and what role we play in providing the overall solution. So the silver lining in the dark cloud that was margin for capital equipment last year was that it certainly put a microscope on top of that problem.
Okay. Just maybe one for my own understanding. Would I be right in saying, Stephen, the main customers for Trajan would be I'm trying to think now. SAI Global, when they were listed, they were taken over by Intertek, but like Intertek, Bureau Veritas, these large global laboratory companies that are servicing, various different verticals, similar to, the ones you're involved in, whether that's medical, environmental, food. Is that the typical type of customer that Trajan is selling into, whether direct or through partners?
That's part of it. So if we think about where do our products eventually get used, who are the end customers? Part of it is those fee-for-service large laboratories around the world, and others, for example, that perform environmental analysis. But there's also a significant amount of product that goes direct into large pharma accounts. So, for example, in the US, companies like Genentech and Pfizer and Vertex are customers of ours. And in the food world, direct in some of the large food companies like Cargill and Nestle and those sorts of companies. So it's a combination of large blue chip multinationals that are the end users of our product, research organizations, contract research organizations, but also that, as you highlight, that large global fee-for-service laboratory network.
And just following on from that, customer concentration risk, maybe just give us a sense of, top 10
Yep.
customers, would they make up,
Yep.
20% of revenue or profit, or whichever way you want to slice it and dice it?
Yeah, happy to talk about that. So our largest customer accounts for about 20% of our sales. And so the first reaction is, oh, customer concentration. But here's the detail which relieves any concern about that. And that is that customer, we supply to more than 10 sites worldwide, and we supply over 500 different part numbers, and we are globally, logistically, and electronically interconnected. And so, to undo that would be a significant undertaking. And in fact, the desire of both parties, I believe, is to continue to expand it. They've grown by an order of magnitude with us over the last decade. Our second largest customer is under 10%, but we have over 1,000 different part numbers supplied to over 50 sites every day of the week. And again, it's a very diversified partnership that addresses a diversity of their needs around the world. And so again, the mode is one of growing the partnership. In fact, if I look at our top 10 customers, almost without exception, all of them have grown with us over the last decade.
And in terms of just, managing, the tariffs now and, the impact of that, other than the 4 regional hubs coming more into play or being established, any real direct impacts of, stuff that just is manufactured in a particular location and now has to go to US based customers, and they're, the option of doing something localized in the US for various, reasons, is impossible. It's like the example I saw on the news of, they don't grow bananas in the US. They do import them from Brazil, and there's no way around it.
Yeah, well, thankfully, I'm not involved in the fruit and veggie world.
Yeah.
No offense to anyone who is. But the answer is there's no showstoppers for us here. We have a multi-pronged attack. If I think, in different ways, we can either put stuff into the US. In some cases, for example, product made in Australia, we are importing into the US through our own entity, and then we supply to our customers. And so the value at importation is an intercompany transfer value, not the final retail value. And then we are recovering that small markup from our customers without any real pushback in the US. And so, there are various ways to deal with this, and we're well positioned to use different tools at our disposal to deal with the tariffs.
And then maybe just a final question, just on the debt level, Stephen. I know you brought it down a bit this year. Is there a target that you'd like it to get to, or is there, whether that's a dollar number or a cover number or even, debt to EBITDA level?
Yeah, so net debt to EBITDA, publicly for a few years, we've been saying our target was under 2. We're there now. And given the cash generative power of the business, the relatively low servability obligation of that, the non-onerous financial banking arrangements we have today. I'm quite comfortable with it sitting there, and foresee us, utilizing some of that capacity and starting to generate additional cash.
Okay. Stephen, we'll leave it there because I have been warned by Marie that you have a hard stop to jump
I do.
onto another call.
It's that time
I
of
don't-
year.
Exactly. I don't want to make you late for your next engagement. So thank you very much for coming on, joining us for the first time here on Trajan. It was great to hear the story firsthand, and yeah, hopefully we can get you back some stage in FY26.
Terrific. Thank you, Mark, and thank you everyone for listening in.
And that wraps up our call for this morning. We will have another call next Friday. As I said, the agenda and invites and everything should be going out about Wednesday. And I wish everybody a good rest of their weekend. Thank you.